Good afternoon. Welcome to the Weekly Livestock Market Update. I'm Brownfield anchor reporter Megan Grebner. With us is University of Missouri Scott Brown, who is on the road today. Good afternoon, Scott.
Good afternoon, Megan.
We're going to take a little bit different direction today because kind of a slow week when it comes to reports and some of those things that we get into. But let's start first and take a look at the markets, which actually have been a little slow themselves.
Yeah, not a lot of trade this week, but when we look at cattle to begin with, first of all, cash cattle prices down over $6 this week. When you look at cash feeder cattle, they were down 1 to 8 this week as well. So tough in terms of the direction we saw on prices. When you look at those current futures contracts as well, live cattle down $4.50, while feeder cattle traded down over $5 this week. So tough when you look at that side of the equation. That choice box beef price up $1.25 this week. Again, I will say still led a little bit by what's been happening with some strength in middle beef prices. However, when you look at that, it's still down 6.8% relative to where it was a year ago at this time. So we haven't gotten quite the same kind of seasonal bump that would have gotten a year ago in 2017. And I think that's been one of the things that's been tougher on cattle prices here as we move through the last several weeks. On the hog side, we didn't see cash hog prices up $3.75 this week, while we saw that lean current hog futures contract down $1 this week. On the pork cutout value, up over $3 this week. Stronger belly prices were part of what was going on in that equation. Yet when we even look at the pork cutout value, despite strength this week, still down over 13% relative to where it was a year ago.
Scott, I want to talk a little bit about, as we're looking at risk management tools and we're looking at prices and what's going on, as we take a look at the future side of things on the hog market, contracts are at a premium to cash, and it's not just by a little bit. I think it's more than double what it typically is for this time of year.
Yeah, so I think we continue to struggle with what's been, again, larger hog runs as we go through this year, and folks trying to figure out where demand for pork ends up relative to these larger supplies. I sometimes might tell producers that it's an opportunity to think about some risk management that otherwise wouldn't be the case. We know those probably have to narrow as we go through time, given how wide they are today. So maybe there is an opportunity there for folks to think about locking in some of those longer term futures prices. A lot of uncertainty when you think about some of the trade issues that exist, and I think it makes it tough to decide for certain what to do, but one certainly wants to watch the difference between where futures and cash hog prices are today.
We know that some of the things that are supportive to both cash and futures hog markets have been, we know that we're going to hit that seasonal slowdown, and we know that demand has been strong. But how does that concern about trade? We have NAFTA trade talks again, China trade talks again. How does that all come into play with producers and as they're trying to balance and look ahead to the rest of 2018 and hopefully sit in the green a little bit?
Yeah, boy, it's a tough balance. I say all the time, where we might talk about not always getting demand exactly right. At least we're talking about a particular demand curve that we can slide up or down at times to maybe offset some of what we miss. Yet when we think about some of these trade agreements that we have coming, either we get a renegotiated trade agreement or we don't. It's kind of a 0-1. There's no in between, which to me just says the amount of risk expands greatly. And that, I think, makes it difficult for producers at this point in time. And that's where I think, maybe if there's some risk management opportunities for individual operations, you might think a little harder about them today than you would at other points in time, just given, I think, that overall risk profile is fairly large right now.
We previewed this last week. We were going to talk a little bit about WASDE's first outlook for the 2018-2019 crop year. As we get that first glimpse into next year, are those numbers a little concerning for producers?
I think they are for livestock producers for sure. And I start on a couple of things here. Number one, USDA has raised their corn price by about 50 cents for the 18-19 year, relative to what their long-term baseline would have said back early this year. And I think that's the general sentiment of what we see out there in terms of corn prices, that folks have raised those expectations. We'll wait and see whether those come true, but that 50 cents increases feed costs. You look on the soybean meal side, USDA also has increased from their long-term baseline soybean meal prices in this first 18-19 look by $25 a ton. So the cost side of the equation for livestock producers seems to be going higher. Yet when you look at what we're doing in terms of overall red meat production and poultry production, we're going to be up again in 2019, some 2.3 to 2.4% higher according to USDA. That comes up on top of what's going to be about a 2.8% increase in overall meat supplies this year. Maybe more pressure as we look ahead in 2019 on prices yet again. So feed costs higher, output prices lower. That squeeze on profitability, frankly, may look worse next year.
Risk management has to be a serious conversation, and we talk about it readily in row crops. You think about, it's easy to figure out cost of production, whether it's per bushel or per acre, whatever you want to put it, whatever frame you want to put it in. But what about livestock producers? When we talk about risk management for livestock producers, it isn't just a black and white conversation like it can be on the row crop side of things.
Yeah, we've certainly seen probably traditionally a little less use of futures markets on the livestock side from a risk management standpoint. And I just go where we are today in the cycle. I know prices for many of these livestock commodities have come down from where they were the past couple of years. Just because they've done that doesn't mean we shouldn't be thinking about using them as a risk management option. I always remind us prices can go lower. And in fact, the previous conversation to me says even in 2019, we could have more pressure on these prices. So what might not look like a very good price relative to a couple of years ago may look really good by the time we get out there into mid 2019. So maybe using those now might be helpful to where producers stay in terms of business as we go into 2019. So a real change, and I just want to keep saying these markets are different and are going to continue to, I think, move in that less profitable spectrum, if you will, as we look ahead.
How much of our conversation do we need to focus on margins?
Yeah, so if we look at kind of farm to wholesale margins, again, I go back, a few years ago, we used to say cow-calf producers were in the driver's seat. There weren't enough calves, enough cattle out there. It put packers in a very tough situation. In fact, we lost some packing capacity when we went through that period of time. And it's amazing what some growth in cattle numbers have done. We've seen some pretty rapid expansion in margins. And now we're beginning to go, boy, we wish we would have some of that packing capacity left on the beef side, because the correlation between cattle slaughter on a daily basis and those margins, that correlation is very strongly positive. And we've just seen what can happen as we increase runs. And again, you look ahead and all we're talking about is probably at least looking at next year relative to this year, even stronger runs, a chance for packers to even push those margins potentially even wider as we go into 2019. Thus, even more risk management may be important. Even on the pork side, we've seen some expansion in margins with the larger runs of hogs that we have today. I think the only reason why those margins haven't gotten even wider, frankly, has to do with the increase in capacity that we've seen coming on the pork side that has kept that a little more competitive for hogs that are out there, despite the growth in overall slaughter relative to a year ago.
Every time I look at estimated cattle slaughter and hog slaughter every day, and just about every day we're seeing more cattle slaughtered than a week ago and significantly more than a year ago. How nervous do we get, and what does that potentially do to prices if we get to a situation like we saw in the pork industry where we don't have enough slaughter capacity?
It could get tough quickly. That's probably not where I'm at right now in terms of how tough it could get. I come back and go, thank goodness demand has been as strong as it's been. I look back at 2017 and go, just really strong demand. And even here in 2018, demand, frankly, hasn't been weak. It's just been the growth in supplies that has come on top of it. So if this economy were to go into a recession here in the next several months, I worry about what that does to the demand side and ultimately then what happens to prices. So the idea of this downside risk is a lot greater than the upside potential, I think is something that we're going to talk about for several more months before we get beyond that discussion.
I'm going to leave that there. and let's transition and talk a little bit farm bill and a little farm policy. Today, the House failed to approve its version of the farm bill. Where do we go from here, and where does that leave agriculture and as they're looking ahead to risk management and farm and safety net tools as we're managing another tough year in the farm economy?
Yeah, I think we're in a little bit of uncertain environment again, given that we did only get 198 votes today to pass the farm bill. It doesn't mean it can't come back up again next week. I think they've left the door open. If they find some compromise that garners the additional votes they need to get to 218, and that I suppose could happen next week. But it certainly throws some uncertainty into the mix. We know the Senate side has suggested that they will be working in earnest on a bill. I don't know what with what happened on the House side today, how that affects where the Senate goes. Of course, we know this current farm bill expires October 1, and we have to do something. I don't know if one can jump to the conclusion that we increase the likelihood of a short-term extension given what happened today on the House side, but it certainly doesn't give us any clear indication of where we head, given we couldn't get to the finish line today on the House side.
Do we get nervous as maybe we talk about the volatility in markets and the concerns about trade and how that all plays in together to also not have safety nets and some of these programs funded that are funded in the Farm Bill?
Yeah, so if you believe there's more downside risk than upside potential, this is where you start a safety net to help protect against that. And if we don't have that out of farm legislation, then financially what happens to a lot of producers. And I think we've seen a situation in agriculture where you hear all the time farm incomes dropped in half from the records it was just a few years ago. It reminds me that there is a lot more financial stress, not maybe not catastrophic at this point, but we're kind of sitting there on the edge of what could be a much more difficult financial situation, and I worry about how quickly we could get in a very tough situation. And again, no good safety nets for producers will put us in a tough position in production ag.
I guess one of the things I think about too is we talk about that downside potential or anything that could disrupt our exports and our demand of our product on the global marketplace. Do we also maybe get a little concerned about the whole FMD vaccine bank and being able to find funding for that, which I know has been proposed on the livestock sector or from the livestock sector, and just maybe finding more of that stability where we really need it right now?
Yeah, well, I think all those things provide added risk. One can tell some pretty negative forward-looking stories if you want. I always like to come back though and at least remind us that we've been in some of the strongest demand that we've seen for maybe a period of time, especially on the meat side. I hope that's what continues to drive us going forward. But an FMD outbreak in this country is certainly catastrophic and will move markets a lot. Getting producers as much help in terms of safety net programs, I do think is pretty critical at this point in time.
It'll be interesting to see how that plays out. Scott, as we wrap things up today, a preview of what we're going to talk about next week.
Yeah, so we're going to start the week with a cold storage report to see what's in freezers in terms of meat supplies. We'll get a livestock slaughter report out on Thursday and wrap up the week with another cattle on feed. And hopefully we'll talk about another month of lower cattle placements relative to a year ago. And perhaps that'll be something that helps us get cattle prices to move higher next week.
Hopefully we will see that. Scott, have a great weekend. We will talk to you next Friday.
Take care, Megan.
To have our weekly livestock market update delivered to your email box every Saturday morning, visit our website, brownfieldagnews.com. Click subscribe. You can also submit questions and comments there. And for market updates twice daily, make sure to check out John Perkins' Market Minute. Have a great weekend. I'm Megan Grebner on Brownfield.